This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter goes through now and looks at you as a financial manager. So we've previously gone through and looked at the financial objectives in chapter 1. We've then gone through there and spent a bit of time on the non-financial objectives and now the guidance that we have in place to help us give more information about the non-financial aspects of a business so that we can make a better assessment of whether or not those non-financial objectives have been met. And now we just move towards looking at you as a financial manager and how you make your decisions and how those decisions that you make are all interlinked, okay? Because when you're a financial manager and you're running your business, okay, you are responsible for the investment decisions, you are responsible for the financing decisions, and you are also then responsible as well for the dividend decision, as well as going through there now in this chapter, bringing in a little bit of corporate reporting, okay, and thinking about how you can manage the risk within the business, so a risk-making decision. So you've got your notes there, but what I'm just going to go through and do is I'm just going to go through there and just give myself a little bit of space so you can have a look and just try and see how all the decisions relate to each other, okay, because what we've got is imagine that you have your company, okay, so that's your little box, okay, that you own. Sorry, not you own, you're not the shareholder, you're the manager, the financial manager, and your aim is to make the shareholders richer, isn't it? Okay, so what you've got to go through and do that is that you've got to go through that and invest in a project, haven't you? Okay, or if you like, you've got to invest in some new non-current assets, or you have to go through there and make an acquisition. The key bit there is that you want to go through there and look at a project that generates a positive net present value, isn't it? Okay, because if you generate a positive net present value, then you're generating more wealth for the shareholder. So what's happening there is that that project generates cash, doesn't it? So what we're thinking about here is the investment decision, isn't it? What are we going to invest in? We're going to invest in anything that gives us a positive NPV, but obviously you need to think about your non-financial objectives as well, because you could invest in a positive NPV project and that might have detrimental impacts on your non-financial objectives because it might consume too many non-renewable resources, or it might go through there and have further disagreements with your local community and the surroundings. Think about the expansion of Heathrow Airport, for an example. That's going to be a massive project, isn't it, that will maximize the wealth of the shareholders. But what about the local residents? There'll be more planes, okay, on a more regular basis, more noise, more pollution, okay, from people driving to and from the airport. So again, maximizes shareholder wealth, but might not keep the locals too happy, okay, and rightly so, okay. So that's the investment decision. When you've got the investment, what do you need to be able to make that investment? Yeah, finance, okay. So you've also got your financing decision, haven't we? So what you need to think about there is whether or not you are going to raise equity finance or whether you are going to raise debt finance, okay. Now, whenever you're making the investment decision, that's what you've got to be careful about, is that you need to make sure there that you need to give your returns, so there's enough cash for the debt holders. So you need to pay them interest, which can either be fixed or variable, okay. It's a fixed return, isn't it? You have to pay that return, but then that return can be a variable rate of interest or a fixed rate of interest. That debt could be redeemable, irredeemable, convertible. Maybe just going a little bit too far, but the key bit there is that when you're investing in that project and you're then taking on board the finance, you need to make sure there that you choose an appropriate level of finance. Now, by taking on board more debt, that might have an impact on your gearing ratios or your interest cover ratios, mightn't we? So we might need to assess the impact that the investment decision, okay, then has on the financing decision, okay. If you're thinking about your equity, the return that your equity holders get there is your dividend, isn't it? Okay. So as well as going through here, I'm thinking about the financing decision. We also need to go through that as well. And think about the dividend decision, isn't it? Okay. If you're making the cash from your project, you've generated enough cash to pay the interest of the shareholders, the debt holders or the debt investors. You've then got excess cash, haven't we? That we're going to go through there and then either pay to the shareholders a dividend, or remember the alternative. What we could do is we could keep back some of that cash as a dividend, don't pay it out, and use it to invest within the project. Now that's another form of finance, isn't it? Using your retained earnings is the cheapest form of equity finance. Okay, so there's a lot to think about there in terms of the dividend decision as well. Okay, and then overall, what you've got there is when you've got your project and you've got your cash flows coming from that project, what you've got there is that you're faced with some risk, aren't we, in terms of the variability within those cash flows. And if we have variability in cash flows, then we could go through there and start to think about hedging. Okay, if we're thinking and looking at your interest, okay, again, if you've taken out a variable rate of interest on a loan and you think that the interest rates are going to go up, there's a risk that you're going to pay more money into the future. So maybe you might want to go through there and do something to mitigate that risk. And when you're looking at that mitigation of the risk, that's when you go through there and think about hedging. Okay, so there's quite a lot to go through and think about. But what I've just tried to do with that weird, wacky, wonderful diagram, it's one of my favourite diagrams that I ever draw up. Sounds sad, doesn't it? But, okay, that's my job. It really does help you think about how it all links together, okay, in terms of by investing in the wrong project means therefore that then the financing decision is impacted because you might have the interest to pay to your debt holders, but you might not have any cash to pay to your equity holders, and that's going to go through there and impact the dividend decision, isn't it? How much of a dividend do we actually go through and pay? Okay, and then on top of that, you've got the risk, haven't we? Okay, how do we then go through and manage risk? And you, as the financial manager, are responsible for managing that risk via a process known as hedging. Okay, so let's go through, get back into the notes and see what we've got. Okay, so when you're making those decisions, the way in which we can assess those decisions and whether or not they will be the correct decision it is how it will impact the following. So your investor ratios, how might it impact your dividend cover, your dividend yield, how might it impact your earnings per share. It talks about your lender ratio, so how might that impact your interest cover and gearing, compliance with your debt covenants. So if you take on board more debt, that's going to change some of the lender ratios, isn't it, with regards to the gearing and with regards to the interest cover. Nearly slipped my mind there. And we want to make sure that we're still within those debt covenants, because if we're not, then we breach those covenants, then we're in a lot of difficulty. Okay, yeah, the loans may be recalled if we haven't got the cash. Could be dangerous. Okay, and as well, and how those decisions impact your financial objectives. So maybe your new project, will it make sure you go through and increase your sales by X%? Will your earnings per share over a period of time be increased by Y%? So whatever targets you have set. Okay, and I'm not going to go through and do hundreds of examples because I just don't think it's worth it. Okay, because you have the knowledge, you know about your investor ratios, you know about your lender ratios, you know what debt covenants are, you know what your financial objectives are by now. You just need to go through and just keep working the questions to see the style of questions that you come across and how you can go through there and develop the right answer. Okay, all we're going to go through and do that is give you just an example of how it could be seen from an exam perspective. Okay, it's not going to cover all aspects. You will learn as you work the questions, and it's not building up a knowledge, it's building up an understanding of the questions. Okay, it's more of an application of the knowledge that you already have. I don't think if I spent an hour going through 30 examples, it wouldn't improve your knowledge in any way, shape or form. Okay, yeah, it would just be too much. Yeah, you have the knowledge, you need to apply it. Okay, so what we've got there is, it says calculate the interest cover. So remember, your interest cover is profits before interest and tax, your operating profit divided by your interest paid, isn't it, by your finance costs. Okay, and see if it is financed using bank borrowings. So it seems like we have a project, it's a positive NPV, we're therefore making the finance decision by saying we're thinking about bank borrowings, increasing the level of debt. If we increase the level of debt, that will increase the level of interest, which will have an impact on your interest cover, won't it? And it says there, determine if the covenant is still complied with, a simple yes or no. Okay, so when you're thinking about an interest cover, you have an interest cover that is set at a particular level. You want to make sure that your interest cover is higher than what is set, isn't it? Okay, so that your interest payments are safer than the level that has been prescribed. Okay, so what it says there, it says Skelton is looking to finance a new project through the issue of debentures. The company is looking to raise $25 million and will pay interest at 4%. Okay, I suppose really it should say that the project will be financed using borrowings as opposed to bank borrowings. Okay, but I shall update that in due course. So the borrowings that we have, let's just cross out the word bank, is the issue of debentures. Okay, looking to raise £25 million, will pay interest at 4%. Okay, so you can work out the interest on that. Is that 4% of 25 million? Is that, I think it's £1 million. Okay, yeah, 4% is a 25th, isn't it? Okay, Skelton currently has 40 million 5% loans outstanding to which a covenant has been attached. It needs to make sure that an interest cover of 5 times is to be maintained. So if we drop below 5, then we are breaching that covenant because our interest expense is at risk, isn't it? There are not sufficient profits to be able to go through that and cover that interest payments. Okay. Skelton's most recent financial statements show profits before interest and tax of 16.5 million. I've been simple here. I'm just giving you the right profit figure. The exam could give you different profit figures to use. Okay, remember the key bit there is that your interest cover is PBIT divided there by your finance costs. If you like, your interest expense, your net interest expense. So here, what have we got? Profits before interest and tax are 16.5 million. Our current loan is it 40 million at 5%. Don't forget now we have the new loan at 4%. So that gives me 16.5 million. 5% of 40 million. Is a 20th, so is that the 2 million, and 4% of 25 is it as 1 million. Okay, so 16.5 divided by 3 is there as 5.5 times, isn't it? Okay, 5.5 times versus, is it 5 times? So our interest cover, even when we take out the loan, is better than what the debt covenant stipulated that we must be above. Okay, we need to be above 5 times. So is the covenant still complied with? The answer is yes. Okay, there we go. And you can work several of those questions within the revision kit. Okay, work your way through. You will make mistakes on some. It's fine. Keep it. Learn from the mistakes. Okay, so use the answer, and if you do get stuck, then by all means ask me. Other than that, I'll see you in the next few sessions when we begin to look at hedging. So strap yourselves in, you're in for a ride.